welcome to this edition of Closing Trades. Right here in ET Now with me, Aisha Faridi, Nikunj Dalmia on the show. And it's a bit of a disappointment, even though that ring of an all-time high on the Sensex did cheer you up earlier today. But from there, we've sombered out. And for the Nifty, it continues to be a wait. I wonder what Nifty is waiting for.
20 more points, maybe this closing show, and it's going to be there. See, it's now just a formality.
Yeah.
So, mathematically, you are almost at an all-time high. Interesting bit for me, frankly, is that this time all-time has been made without Reliance, without Infosys, and without HDFC Bank. So the sectoral leadership, which is we always talk about, that the markets after a periodic gap will come back, but the stock which take the market higher, they're going to be very, very different. So that I think is the big realization. Second, we are nowhere close to what could be called as a bubble, euphoria, all-time high. While nobody is celebrating, hardly there are any big believers. In the last couple of days, some naysayers have turned believers. There is a lot of left out feeling on the sidelines. But this market, in a sense, if you frankly ask me, has rewarded patience and discipline. If you're an SIP investor, you kept through the course, through the highs and the lows, through the peaks and the troughs. All you've had to do is that just stick to your financial allocation, and all you had to do was to maintain your discipline. I think this market has very, very handsomely rewarded. And that's what markets are. You stick to your discipline, you stay on the course, you ride the highs, and you stay when the lows are there. Law of averaging, in a sense, for an SIP investor will always be beneficial.
Basically like Shavasana. Like Vikas Khemani was saying, stand still, do not move, and you will get there.
Yeah, if you do a poll that when the Sensex will touch 1 lakh, nobody is like, reacting with the jaw drops, kya number hai? This is not like something which will ever happen. It's a very conceivable number. Mathematically, you can make a case that even if you, see, you've multiplied or you've compounded at about 12 to 13% before dividend. That's the historical average. Next 5 years growth, looking at where we are right now, assuming all goes well in the election cycle, will be better than our historical growth. If that is the case and valuations are not that expensive, then you would imagine that you will do an inch higher than the historical average, which is 12 to 13 will become 13 to 15. So you put the maths here. The best case scenario, there's a T20 outcome, 3 years. 1 day outcome, 4 years. Test match outcome, 5 years. So 3, 4, 5 is what I think is the time frame in which the Sensex will touch 1 lakh.
Okay, but today we are celebrating the Sensex hitting an all-time high, still a mark away from that 1 lakh mark. But let me take it across to Anisha. She's surely been part of the celebrations right there at the Bombay Stock Exchange. Anisha, is there a lot of buzz around with the Sensex hitting an all-time high, or is everyone now only waiting for 1 lakh?
Oh, well, no, we're right here at the heart of the throbbing, the Lal Street in Mumbai. And of course, there's a lot of celebration, a lot of cheer which is around. It would have been better if it was Nifty as well, which would have hit a record high. But nonetheless, you can't take away the fact that Sensex has hit a record high level today. And behind me, of course, is the iconic bull, which has been the key indicator of the raging bull market that we are in. India, of course, is already the 5th largest equity market in the world, and all eyes on that 100,000 number on the Sensex. So who better than that sense from Dipan Mehta, who's been associated with the Bombay Stock Exchange for what, 3 decades, Dipan?
Absolutely, yeah.
Dipan,
but I've been investing for almost 4.5 decades or so. I don't look that old, I hope.
No, you absolutely do not. The bull does not look old, and it doesn't look like it's stopping anytime soon, right? Tell me, what do you think is the difference in this in this record high versus what we saw in the month of December? Because a lot has changed, right? We hadn't seen the tail of inflation then. Crude was at higher levels. Do you see more legs to the rally now?
See, let's answer the first part. What is different this time? So while the Sensex has crossed a new high, I'm telling you that individual investor portfolios have been at all-time highs much before that. So it's the beauty of this rally is it's widespread. It is then the small mid-cap stocks, and actually it is creating wealth for the investors. And if some of the investors had any doubts about the kind of returns that they could make in their equities, and they have been, of course, investing through SIPs and mutual funds and direct equity, I think the last few weeks have, clearly shown that equities is the place to be in, and the highest returns are being delivered by our markets. So the big difference, of course, is the fact that portfolios are doing very well. Sensex Nifty, of course, I think is just an indicator of the underlying large companies per se. The second thing, I think, yes, a lot of the problems which happened in the last 5-6 months since the Nifty had hit a new high, Sensex Nifty hit a new high, was of course this inflation interest rates. And now I think that is stabilizing globally and in India. And because of that, we have what is called a risk on trade. And that's fantastic because you have more and more global money coming into India.
Exactly.
And that's reflected in the FI flows as well.
No, well, absolutely. And it was a grueling journey, right? It took almost 137 sessions for us to come back to these record high levels. And you know what? I'm not sure whether you know of this trivia or not, but it was 86 when the term Sensex was coined. It took us 20 years to hit the first 10,000 mark. And since then, we have been galloping. But the question is, will we gallop now to that 100,000 mark, which we've been asking everyone on the Sensex? Do you see that happening in the next 2 to 3 years, or is it going to be longer? What's your sense?
I guess I would say 1,000-day target, so about 3 years or so to reach, maybe earlier as well. You keep in mind that Sensex is a large, 30 large companies and they are mature businesses, large base, so it takes a while for them to generate that kind of return to take the Sensex up to 1 lakh. But I think at this point of time, investors can easily expect about 15 to 20% type of returns compound over the next 2-3 years or so. That's assuming there is no negative factor, there are no geopolitical events, and there are no accidents. But save that, I think we are on a very strong wicket over here, and we should be able to build on these gains which we have seen in the last few months or so. And typically, I think we are moving out of a very narrow range after almost 6 months. So once we convincingly cross the previous high, go to that 19,000, 65,000 level for the Sensex, you will, I think, see a lot more trading interest. And you will see maybe a lot more leverage interest as well, but that's part and parcel of the whole market, and that can drive the markets higher.
Let's keep our fingers crossed for that. But you know, the other thing that you talked about, it's been very broad-based. It's the portfolios which are doing well, but it's the large cap names which have been underperforming, whether it's your HDFC Twins, ICICI, Kotak, Reliance, they haven't moved. When do you see that happening, or do you think this year is going to belong to mid-caps and small caps?
No, I think that this year and the next 2-3 years will be mid-cap and small cap.
Okay.
That doesn't mean that the larger ones which you named just now shouldn't do well. It's just that the likes of Reliance, HDFC, Kotak, ICICI, they require a lot of muscle power coming in from the foreigners. When the FIs invest into the ETFs over there, which in turn invest over here, or we need stronger FI flows into our country for those stocks to start to rally. But I think even other than that, assuming that their valuations remain constant, the underlying earnings momentum of these companies should take them at least 13-14% compound for the next 3 years or so. So I'm not that perturbed. I think you need to have a mix of large cap, mid cap. You need to have a mix of all the industries as well, so that you can participate in all the various investment themes which are happening in this country.
And there are a lot of themes, right? So let's narrow it down. Tell us the theme that you have the highest conviction on. Is it the BFSI space? Is it manufacturing? Is it defense?
See, first of all, the underlying big theme in India has and will be consumption.
Okay.
Right? So we had the FMCG stocks, they create huge wealth creators. But now we have so much of choice when it comes to consumption, right from multiplexes, healthcare,
QSR.
You can even add QSR, automobile companies, appliance companies, real estate, building material, list is...
Hospitality,
Exactly.
and list
so
goes
there are
on.
many, so that's where we are focused on a hell of a lot. We want to get the next big consumption wave right, which are the products, which are the services we're going to look at, because the multi-baggers, the outperformers are going to come from there. But from a strategic point of view, I think next 2-3 years looks exceptionally good for two sectors.
Okay.
One is banking and second is capital goods. Because of the capex cycle which has turned, I'm positive over there. Order books are really ballooning for a lot of capital goods companies and engineering construction companies. And banking, I think we all know the story. The NPA levels are low and the economy is revving up, so they are having higher and higher volume of business, which is reflected in the top line, bottom line. So these are the two industries. But if you ask me, the evergreen, the ultimate theme to invest in India is consumption.
Okay, so why don't you tell us one stock that you like, whichever theme, banking, consumption, capex, give us one
Okay,
stock.
disclosure.
Yes, all the
We are not
disclosures
clients
in place,
or
not a
interest
recommendation,
invested,
etc.
yeah. So in the banks, we like this IDFC First Bank. I've discussed it on your show many times with Nikunj and other co-anchors as well. Basically, I think it's a very aggressive company. They built a solid brand. They are focused on building their retail deposits, and they have amongst the highest net interest margins in the industry. And it's a great sort of growth stock to own at this point of time. And the capital goods, we're very positive on a niche player called Praj Industries. We discussed that also on your channel before. It's, of course, that company is chasing the ethanol opportunity, but they have got great export prospects as well as in India. I think the way the government is giving impetus to sugar companies to set up more and more distilleries, I think they should have no dearth of business. You could also add VA Tech Webag to that list. It's a water projects company, and we all know because of these weather patterns how important water is and water conservation projects are.
You talk about the weather patterns. How can I not ask you about the monsoon, which has been quite delayed? We are here in the scorching heat, and there's no respite, no rain gods being kind to us. But do you think that could spoil the party?
Yeah, but I think it's sentimentally negative.
Okay.
Right? Monsoon, having seen many monsoons over decades, I can't remember a situation where because of a monsoon failure, we had a huge crack in the market.
Okay.
End of the day,
But
monsoon...
like turnaround of the story, let's say because inflation was ending, there was this entire margin story that we were talking about when it comes to consumption and FMCG names.
Yeah, you could have some impact, but the beauty of Indian markets is the diversity.
Yeah.
Right? So if some sectors are being impacted by the monsoon, there'll be others which will continue to do well. The urban consumption, the export-oriented businesses. Who knows, I think in a couple of quarters, if US starts to stabilize, you could have a, recovery in IT spends, which may take software companies higher.
Okay, so a lot of levers available for growth. That 100,000 mark is a matter of when and not really an if. And of course, it's been a great journey so far as well. But on that note, we'll do one thing. We'll slip in a very short break. Don't go anywhere. We'll track the markets when we come back.
Jatin Khemani joins us, managing partner is here with Stalwart Investment Advisors. Jatin, hi, good to have you on ET Now. Let's understand what you make of today's, the recent market action. We've come up in a linear manner, 15% for the Bank Nifty, 10% for the Sensex and benchmark indices, on an average 20 to 25% for good quality small and mid-cap stocks. What would you make of the market setup right now?
Hi Nikunj, thank you for having me on this show. It's a pleasure to be here. Of course, market has surprised most of us. Last 3 months have been phenomenal, especially when you look outside the index. Most stocks have gone up 20-25%. We are at lifetime high today. So I think this partially is explained by the flows, right? So if you step back and see last couple of years, I believe FIIs put together would have net done an outflow of anywhere between 4.5 to 5 lakh crores, right? And just in last 3 months, they have pumped back some 40,000 crores, less than 10% of what the outflow was. And we already are at lifetime highs. So add to that the steadiness of the DII flows, right? We have 13, 14, 15,000 crores coming steadily from the domestic investors. In terms of SIP alone, credit where due, all the MF Sahi hai, the wealth ecosystem has actually ingrained this in the mindset, which is now proven to that even in a bad patch of last couple of years, when markets did not practically go anywhere, the SIP flows have remained very strong. So now when both put together are playing out at the same time, we have FIIs coming back, and we also have the steadiness of DII flows. The markets are where they are, right? They're at lifetime highs. Now to predict, it's impossible, right? What would happen to FII flows from here on, how the global macro would move. As we know, in the short term, markets are a voting machine, right? And votes can go anywhere based on the sentiment. It's an impossible task to do. But having said that, the FII flows have just reversed. We've just got a fraction of what we got back. It'll be exciting to see how the liquidity-driven rally plays out, and then it'll be back to over a medium term. The baton would be passed back to earnings and fundamentals, and we would have to see how those play out, because that's the other part of your return, right? First is the valuation where you stand and the flows, and the other is how the earnings move forward. So if I can add, in terms of valuation, where do we stand today? The consensus estimate for Nifty EPS next year is roughly, let's say, about 1,000. And as it happens every year, like a tradition, we will have downward revision every quarter as we go forward in the year. And let's say we end at 950. Now, if Nifty EPS is expected to be at 950 for FY24, and we are somewhere at about, let's say, 18,900.
Right. Jatin, so just give us a color on where is it that you are still finding value in the market and what are your overweight recommendations?
I am afraid I would not be able to talk about recommendations. We are registered. We might have ownership in the stocks discussed. So that's the tricky part. But I can talk broadly about a couple of things. So a space which we really like is manufacturing and engineering. And an opportunity from there where we have been invested for a while and which has done very well for us is Usha Martin. So they are expanding capacity. And although a lot of re-rating has already happened, but from an earnings standpoint, it seems interesting. Now, while that was a special opportunity, the other theme we like to play is mean reversion. The best of businesses, the best of industries go through bad patches, and when you identify them during that weak phase, you tend to make significant money when things turn around. So one space which fits really well is dairy sector. I can just briefly share. Last couple of years have been a rough patch for this sector due to COVID. The farmer community could not vaccinate the cattle properly. There was a lumpy skin disease. Procurement prices crashed, and the fodder prices went through the roof. So a lot of things that could go wrong went wrong for this sector. As we stand today, I believe a lot of things are getting resolved. You have 4-5 listed players, right from Hudson to Heritage, Dodla. You do your bottom-up research and pick or make a basket of it. But from a top-down standpoint, the sector looks interesting from a mean reversion perspective.
It's a very interesting array. Is there a conscious reason why you invest more in mid and small cap stocks and not in large cap stocks? I mean, is that a conscious strategy? Because what we've discussed so far with you are largely mid cap names.
Absolutely, because it's far easier to create alpha in small and mid caps, which are less tracked and which are outside the scope for most large institutions, most large investors. So you have better opportunities there. Also, the large caps are part of index too, so they get so many flows. There is no information or analysis arbitrage there. Whereas if you do deeper research on small and mid caps, you are active on the ground, you do your scuttlebutt. I think there are a lot of gems, and your opportunity size suddenly, your universe increases to 1,500, 2,000 names. Whereas in large caps, you're restricted to top 100, top 200 companies, which are very well discovered, tracked, and hence very difficult to create alpha from. Of course, the behavioral edge still lies there too. In a bad cycle, you buy even a large cap and you tend to make a lot of money. But I'm talking in general, the alpha creation opportunity present itself more often than not in the broader markets.
Sector where, in general, I've seen over the years, large money has been made by big banks, by big NBFCs. How are you approaching that space? Because if you're a mid cap and a small cap investor, then are you giving financials a skip?
Not really, but at the same time, we don't want to have 40% in financials. And the reason is very simple. See, I am fairly bullish on the economy to do well over the next 5 years, but I'm not sure if the index will represent that, right? Because the representation from BFSI sector in real economy is 6-7%, while in index it's 40%, right? So, and some of the really great wealth creation opportunities which we had in last 10 years were not even part of index. So chemicals was not there in index. Healthcare has a minuscule representation in index, and so on and so forth. So a lot of these companies would make it to index once they have delivered phenomenal returns. Coming back to your question, when it comes to banks, we strongly believe you don't invest in the bank, you invest in the banker, right? And again, the view is 5, 10, 20 years, not next week, next quarter. For them, the monitorables will be different. For us, being long-term investors, we strongly believe that we invest in the banker and not the bank. And when you look at that, your opportunity size suddenly is very limited universe. Bankers who have seen multiple cycles, and their asset side is also tested as well as their liability side is tested, and they've stood the test of time, and they have conservatively run the show without big damage even in the worst of the times. So as we can guess, there are very few names even in large caps which meet that criteria, and we do have exposure there. So it's not that we altogether ignore large caps. If we have a growth at reasonable sample price opportunity where we can make 15-20% CAGR, we happily look at large caps and have exposure to that side.
Stay with us. Let's address some of those other buzzers in trade outside of the large caps. And Piramal Enterprises surely is one stock which is on fire today after it offloaded its entire stake in Shriram Finance. While the overhang from the Shriram stock has surely been lifted, why is Piramal Enterprises gaining the way it is in trade? On last count as well, it's higher by 13.5%. Harsh from our research desk joins in to explain exactly that.
Well, yes, on the back of that entire Shriram Finance news, we also have Piramal Enterprises buzzing, and that's largely because analysts ascribe a 20 to 25% discount or holding company discount of sorts for any shareholding that a company may have in another company listed or otherwise. So you have that holding company discount actually going away, and you also have a transaction which is happening largely at fair market value. So that is one key positive which is unlocking value within Piramal Enterprises. The other piece is that clearly the direction in which Piramal Enterprises seems to be going is asset monetization. So they have the likes of their insurance arms, including Shriram General Insurance, which also they own stakes in, which could possibly be valued at roughly 3,000 odd crore. So you have that unlocking possibility also coming through. And on the back of that, there could be good positivity also coming through with certain other value unlocking happening within the group and within the holding structure. You also have the capital adequacy ratio of Piramal Enterprises going up from 31% to 35% as a as a consequence of this particular value unlocking which has already happened, and it's a positive that will push for growth. You already have a 15% plus guidance with regard to credit growth coming through, and this will of course aid that. Also in terms of valuations, we have seen Piramal Enterprises trade at 0.8 times price to book versus some of the other players which are trading anything between 5 to 1.4 times price to book. Shriram Finance itself trading at around 1.5 times forward price to book. We also have the likes of a Chola trading at 5 times, Bajaj Finance of course at a much higher rate. But broadly, this being at 0.8 times is one of the cheapest in the industry. On the back of all of that, you can see Piramal Enterprises suddenly buzzing in trade.
All right. So let's shift gears, Jatin, and talk about a sector where mid-cap has done better than large cap, and that's IT. Different companies in the mid-cap space have outperformed large cap companies like Infosys, TCS, and even for that matter, Tech Mahindra in last 1 year. What is the best way to understand this entire tech cluster?
I suppose the underlying factors which I just explained, how small and mid cap operates versus large cap, is also true for this question too. So a small or mid cap IT company would have more exposure to a certain section or certain geography or certain type of clients, which may or may not be impacted that much. Whereas if you talk about a TCS or an Infosys or an HCL, they are so large, they have practically exposure to all the sectors, all the large clients, all the large geographies. And when there is a macro slowdown and you are the largest player, it is impossible to escape that, right? But if you are a niche small cap or a mid cap IT company or a product company, you may or may not get impacted to that extent versus your larger peers.
Right. Okay, just want to see what else is buzzing in the market. There's Lupin as well. Of course, it's a news-based reaction. That stock is holding up a solid 5.5% as we speak right now. So that's a big buzzer in trade. In fact, quite a few of these pharma names are doing quite okay. They've got the US FDA approval for generic Spiriva, which is the first generic player to get approval for this blockbuster drug. And, some of the brokerages are estimating a gross and net sales of the brand around $1 billion to about $500 million, respectively. So that, of course, has put Lupin in a different sort of trajectory today. Idea as well is bouncing up in trade. There's MFSL, which is also holding out. And most of the HDFC group stocks are the ones which are actually comforting the markets today. So HDFC Bank and HDFC Life really has been on a one-way move up. That continues to hold out even in today's trading sessions. Jatin, I'm not sure if you're looking at the insurance space at all and the kind of recovery that they've made from those budget time lows.
That is actually a space which we like, and we like life insurance better than general insurance, given the competitive intensity and the ease of ability for new players to enter. We believe life insurance, in terms of penetration, in terms of the advantage incumbents enjoy from a credibility network standpoint, is here to stay. And there could be near-term challenges on growth or otherwise, but from a long-term standpoint, this sector looks pretty interesting. And valuation too, while the stocks could be at 52-week high or something like that, but I believe from a valuation standpoint, a lot of them have seen time correction over the years, because last 2-3 years they did face some headwinds, and providing opportunities for people with longer time horizons to build positions slowly and steadily.
Okay, Jatin, great to have you on the show today. Thank you so much for taking the time out. Let's just revisit what the market is up to right now. We're holding out absolutely flat in trade. So still a while to go, I guess, before we make that high on the Nifty at least. Let's get some closing ideas then. Naresh, let's have your list first. Naresh, you got to unmute yourself.
So that would be a buy on Samvardhana Motherson, which is giving a breakout right now over that 85 mark. Good volumes here. The last time also it had got some resistance around 85, finally taking it out. So it would be a one-year high as well here. So looking at it as a quick trade towards 1995.
Naresh, what about your closing strategies?
Yeah, so I'll that's okay. I'll suggest a buy on HDFC Bank. In fact, that's a stock which today has given a good breakout. I think trading at 1600 plus mark, 1620 plus mark looks attractive for a potential target of at least 1680 to 1700. So that's a stock which I'll be bullish on.
Okay, on that note, let's take a very quick break. When we come back, the last lap of today's trading session.
There's a bit of a profit booking which has kicked in Zomato, Paytm, Policy Bazaar. Some of the stocks have slipped. I would use the word slip here, not like a crack. Paytm 878 days low. PB Fintech almost crawling back to the days low. Nykaa has not participated at all. So it's a immaterial stock now. Kunal, what could be the turning point for some of these new tech stocks? They've had a crack and a V-shaped rally. Are they likely to extend themselves more?
I think they should extend the rally for themselves. I don't see an immediate correction for either of the names. So I think whether it's the likes of Zomato, which I think has done exceptionally well from I think 45, 47 rupees, 50, 52 rupees rather, just about 2 or 3 months back to now 75 odd mark. So I think it's done reasonably well for itself. Policy Bazaar, I remember I think post the budget is where the stock picked up pace, and I think it's gained more than 35% from those levels. Paytm has been one of the recent breakout stocks. Even Nykaa has recovered back towards the 200 moving average. So when you look at the 4 charts as such in a very broad-based manner, the trends have been very strong, very sustainable, and it's not gone through a very V-shaped recovery. These stocks have had their phases of correction even in the last 30-40% of the rally for individual for these individual names. So I think that's where I would believe that the trend should be sustainable.
Okay. Let's welcome on board then Varun Sabu from Anand Rathi Equities and understand what he's making of the market right now. Varun, hi, afternoon. Let's first pick up on the the new age tech names, so to speak, and the kind of volatility that they have seen. Sure enough, recovered from those previous lows and almost doubled from there. But would you say they're out of the woods? And anything that you like particularly at the current valuations within this entire sector?
Yeah, so on the tech front, there is so much that is happening, right, that we are seeing. So one of the reasons why they had corrected that much was because we were seeing the crazy interest rate rising scenario, which was on where NASDAQ was collapsing because people were seeing stocks over there on DCF. And that's what reflected in our tech stocks, in our high growth tech stocks also. What is happening is that fundamentally businesses are picking up, consumption patterns are changing, things are looking extremely up from all perspectives in our economy, and all of these companies eventually benefit from this. Plus, with the view that interest rates are kind of pausing and would start pivoting sometime, say if not now, in a quarter or two. these could be the names which could benefit on valuations as well. So as such also, there's so much liquidity in stocks. These stocks had some value after the correction they'd seen, and that's what you've seen. I don't see any reason for these to come off sharply. From here, they should kind of be market performers.
Naresh, these stocks were oversold. Have they become overbought now? Because it's the pendulum which swings from oversold to overbought and overbought to oversold. Naresh.
So in the near term, yes, some of them have become overbought because they've gone up 30, 40, 50% over the last 1.5 months. So out here, yes, overbought in the near term, but not that overbought wherein you say it's a top in place. So a 10% correction from the recent tops would be normal. So expecting some bit of a dip and pause in a lot of names which have moved up in the near term. And that would be part of the, say, cycle wherein you go down 50-60%, make a bottoming out formation, go up 40-50%, take a little pause, and then maybe another leg up. So for now, would be waiting for a dip in some of these names to look for an entry again.
The new age tech space. But today, of course, the big news maker has been the Sensex. Yes, sure, you could crib about the fact that we couldn't quite latch on to that all-time high, but we made that attempt on the Sensex. But I think the bigger question is, like Nikunj was earlier highlighting as well, do we make it to that 1 lakh mark on the Sensex? And how soon do we do that? And I don't think there is any market expert we've spoken with who does not believe that we could make it to that level. It's just a matter of time. In fact, let's hear out some expert opinion on the same.
No, that to me is very reasonable. Yeah, very. I would be disappointed if the Sensex had not touched 100,000 5 years from now.
I'm absolutely certain it will reach 1 lakh. Now, whether it happens in 4 years or 6 years, frankly, is really a meaningless debate. But looking at the nominal GDP growth rate, which we are looking, you can safely say we can grow between, say, 12 and 14%, maybe 10 and 14%. You will approximate that number, and if you compound it at that, so in 4 years, roughly from 60,000, you add another, say, it comes to approximately 1 lakh in 4 years. I mean, it's not a reach to see 1 lakh, just at the simple compounding of the nominal GDP rate. I think it's a given, 100%.
Market को predict करने की कोशिश मत करो. More often than not, you will be wrong. But today, is 1 lakh Sensex looking unimaginable? Answer is no. And my request to this audience will be, just don't think about 1 lakh Sensex. Beyond that also there is a much, much longer journey.
Generally speaking, if a country is growing at 7%, you can expect companies, reasonably good companies, to be growing at 14%, double the growth rate of the country. So it's very possible that you can get this incredible growth in the size of the market and the actual investments in the market, no question.
I haven't done the maths, but why not? Really, why not? It's just basic compounding. It's going to get there, yeah. Having been in the market for 30 years, I saw the Sensex at around 1,000. So that's like what you're talking about is a 50, 55, 60% move. So I'd see that there's no reason.
Because I don't invest in any Nifty stock or any Sensex stocks and all. So when I talk about Sensex, that means I'm talking indirectly, I'm talking about my portfolio. So whether index doubles from here or not, that is a different issue. But I expect that this mid-caps where I am investing, in the general mid-cap category, good stocks should double or triple in next 2-3 years time. And so far index is concerned, I think that index is a counting of 21 is happening index, 21,000, 42,000, 63,000. And I think that next stop should be 84,000 in 2 years from now. And of course, 100,000 is just a destination, I think, and miles to go for index.
So for that, my simple thumb rule is compound at about 13-14% and see whether 1.14 to the power of 5 into 66,000, does it become 1 lakh or no? So plus minus, it would be there. Because broadly speaking, if I look at it over any reasonably longer period, the returns have been in this range. So, it doesn't need too much of rocket science. That's why I tweet saying you want 2 lakhs, you just extend the number of years. Because broadly speaking, this number doesn't come only from the fact that historically this has been the range over last, I saw it over 3 or 4 periods, which is 5-7 years. And then I think I did 14 odd years and then some 20 years. And then my own track, my career, which is about 26-27 years. And broadly over every period, it is in this range. But this range is not just coming by looking at historical numbers, but by the fact that Indian GDP in rupee terms grows about 11-12%, and then you can add 1 or 2 more percent for the fact that corporate sector might be doing better than the rest of the economy, or you might be doing it from an equity risk premium point of view, that equity returns are normally 5-6% more than the fixed income 10-year type return of the same country's government bond. These are all worldwide things. And also broadly, we feel that for a large part of the corporate sector, the earnings growth for normal, once they become a little, this thing is in the range of 12, 13, 10, 15%. And then some companies grow at 20, 30% for some periods of time. So from all angles, it looks that that is the thing. So you just multiply and see, but I would think it would reach somewhere there.
Seems like Sensex at that 1 lakh mark seems an eventuality. It's just a matter of time. That's pretty much the consensus coming in from most of our experts. Right now, though, we're around that 16,450 print in trade and 18,860 for the Nifty. But what's the buzz across dealing rooms? Let me take it across to Sharad and get in all that info. Sharad?
Well, yes, in focus we are having Saregama India, and the stock, what we are hearing from the dealers is that there has been a sustained buying coming from domestic institutions for the last 2 trading sessions, and also it is said that ace investor Madhukala has been acquiring stake in the company. Now looking at the volumes, it's coming at almost 6 times its 2-day average compared to the normal volumes. Apart from this, we look at the key investors already invested in the company, and these international names include Abu Dhabi Investment Authority, Government of Singapore, which is the GIC fund, and also Malabar India Fund. Now if you look at the FI holding itself, that comes in at roughly 80% of the total shareholding. But now let's look at the key triggers for the company, and the recent management con call was also there, where they had stated that they're aiming for a 25 to 30% incremental share when it comes to content, and of course there would be a lot of push coming in, especially for the subscription model for the southern markets. Apart from this, also the management has estimated 2 important items. First is the lower marketing expenses are going to aid the margins going ahead, and they're expecting in FY24 that there would be big ticket, big budget film music releases, and that will of course help the top line numbers as well.
Okay. Varun, what do you like from this niche consumption space? Ethios, Saregama, Landmark, Sula, everyone's got a preference.
Tough one. I mean, we don't cover most of these names, so it's a tough one for me. But I'm very bullish on consumption as a theme overall. So any consumer item, it might be staples, it might be discretionary, it might be niche consumption, it might be anything, I'm extremely bullish on. So India is going to see a huge wave of consumption in the next 3 to 5 years, in my view. So anything you pick up in consumption will do exceptionally well. Yeah.
Stocks, that shouldn't be a problem for you.
Yeah, I think some of the names which Nikunj mentioned, like Ethios, I think it's a fantastic stock in terms of the last 1 year of uptrend. Post-listing, the stock has done exceptionally well. There was just one phase of a correction, I remember, I think for Ethios, I think the last 2 months where the stock had corrected some 10-15%. But the way the stock has recovered back towards 1300 mark from 1000 levels, I think it's about 3-4 months back, I think is exceptionally strong. So a lot of the stocks from this space look attractive.
And I think, that's the other debate, right, Nikunj? Because the luxury end of the market or consumption story is very well known, right? We've already seen the kind of numbers that you're getting from some of those luxury realty plays, cars, watches, whatever you can think of. Is now the time to go confident bet on the rural consumption play?
No, Aisha, I'll tell you why. Because ultimately you have to look at, do you want to go for mass or you want to go for companies which will enjoy pricing power? A luxury watch, and if the design is nice, the buyer does not mind paying that 10% premium. But if you're buying, let's say, something which is where the price conscious consumer is there, he's not going to pay that 5% extra just because the packaging is great. Apple is a great product company, because they make good products and they charge a premium, and that has given it a market cap of $1 trillion, because they connect very well with the appetite and the demand and the design appeal of the consumer. I've always said that, look, Do you want to go for mass or do you want to go for niche? In India, the way the society is migrating now, we are going towards what could be called as pyramidization of the structure. And you should always be with companies which in a sense will get disproportionate amount of benefits, margins and mind share, provided you get that product right. The reason why you have less rich people on the planet and rich will always remain rich is because they understand how to create wealth. It's nothing like a comment on that's a societal structure which you have in the world. That's the way it is.
Yeah. Okay, let's get in some BTST trades as well going on that note then. Nuresh, let's have your calls.
So first would be a buy on Samvardhana Motherson. The stock has broken out. Stop loss at 84 and a target price of 90. Second is a buy on Max Financial Services. Lot to catch up with the rest of insurance names. Stop loss at 728 and a target price of 760.
Right. Kunal, what about your ideas?
So I'll go with a couple of buy calls and expecting or anticipating buy into few trades. So Tata Chemical is the first stock. The stock has been into the lot of news flow negative. But I think at current levels of 995 approximately looks very attractive for a breakout. 1040 as the target for Tata Chemicals, expecting a breakout. Stop loss at 975. And TCS is the other stock from the large cap IT space. Looks attractive. In fact, on the hourly charts, it's formed a triple divergence on the hourly time frame. Looks attractive for a potential target of 150 points on the upside. So 3,400 as a target and stop loss at 3,150.
Okay. In the meantime, some of the buzzers today are from the pharma pack as well. So Lupin, of course, being one such case in point after they got the US FDA approval for generic Spiriva. They're the first generic player to actually get an approval for this blockbuster drug. And, the valuations or rather the gross and net sales for the brand are pegged anywhere between about $1 billion to about 500 million as well. Apurva, just wanted to get your sense in on whether or not there's anything within pharma that you're eyeing right now, or for that matter, the larger healthcare or diagnostics universe. Varun, can you hear me?
Yes, I can. Yeah.
Yes. No, the same question to you, whether or not there's anything within healthcare, beaten down diagnostics, or for that matter, pharma, which on a case-to-case, news-by-news basis is seeing some amount of recovery.
So I had come last time also on the show and I mentioned that I'm not a big fan of pharma companies at the current juncture. The only thing what is exciting here is the valuation. So what is happening is that any one positive news comes, like for the example you're seeing in Lupin, and Lupin has a lot of value in the stock. So that's where you see the reaction coming, where the stock the stock zooms up for that day, right? But I don't see any significant triggers to be there to have any sustainable rally in this sector or in companies out here. I just met one of these companies in the last couple of days. I would say that if someone has to accumulate a name over here, I think Biocon is a good one to look at. Yeah.
Other than pharma, what are your other underweights then? Sans, of course, Biocon.
So we are not very bullish on banks also. So at this juncture, I think that banks would not outperform. Banks would probably consolidate or correct a bit from here, considering the fact that in an interest rate pivoting scenario, your margins start contracting for banks. So I think that is one space which we're not too excited about. And I mean, these are two spaces which we would kind of stay away from, but not much that I can stay away from, right? In a country where everything is going so right and markets look very promising to me. So apart from these two sectors, I think I'm pretty bullish overall.
That you say banks, would it also hold true for consensus names like an ICICI Bank or an IDFC too?
So ICICI Bank is in a different zone. It's one of the names which will keep compounding over the years, and it's a great franchise that's been built with a lot of processes being right. And you don't tend to see these names, but yeah, they will go through consolidation. There will be phases of consolidation which it will enter into. There can be a 5-7% correction here and there. But will these companies compound at 12, 13, 15% per annum from here for the next 5 years? It can, and it should, I think, for the kind of franchise it is. IDFC, you said IDFC, right? The other name? Doing quite well. They've done the hard work, so things are reflecting in the way the stock has performed. But again, there's a value to everything, right? So in terms of valuations, the kind of re-rate it has seen, I think it is kind of fairly valued at this juncture, can be consolidating for a while over here. I would probably be betting more on names like an IndusInd Bank or a Bandhan Bank from here, rather than so these are the two banks which are yet to see that margin benefit to come in, because so these are the ones where the margin benefits are back-ended, and that's what will keep reflecting from here for the next few quarters. So I think IndusInd and Bandhan would be my preferred picks over here.
Okay, Varun, great to have you today on the show. We let you go on that note. In fact, just 2 minutes left to go, or less than that, actually.